Hi everyone, welcome back to our channel. Today, I am very excited to be sharing with you the first set of enlarged ELOG financial results, released after our merger with ESR-LOGOS Logistics Trust completed in April earlier this year. ELOG is now a 5.5 billion new economy APAC REIT comprising 83 properties in Singapore and Australia, as well as investments in 3 Australian property funds. We are also a constituent of the FTSE EPRA Nareit Global Real Estate Index, which has resulted in higher trading liquidity for the stock and increased investor visibility. Let me share with you a quick snapshot of our first half 2022 results, starting with our financials. This 2Q 2022 is the first set of financials for the enlarged ELOGs since the merger. As such, the most relevant comparison is with 1Q 2022. DPU for the second quarter was at 0.737 cents, 1.9% higher than the DPU for the first quarter of this year at 0.723 cents. This is the third consecutive quarter of DPU growth and is the highest of all. Gross revenue grew 23.3% year-on-year to 147.7 million, while MPI rose 18.2% year-on-year to 102.8 million in the first half of 2022, mainly attributed to the contributions from the completion of the ELOG merger. However, NPI increased at a slower pace as compared to gross revenue due to higher utilities expenses arising from a surge in global energy prices and increased electricity demand as the economy recovers post-COVID-19, thereby resulting in higher property expenses during this period. The amount available for distribution also registered a growth of 29.6% year-on-year to $73.6 million. Rental collections for the first half remained healthy at approximately 98% of total receivables. While not an appropriate comparison given the different basis, DPU for the first half of 2022 was at 1.46 cents, 6% lower year-on-year from 1.554 cents due to higher utility expense as well as the full impact of an enlarged share base from the equity fundraising completed in May and August last year, where a portion of funds raised were deployed towards asset enhancements initiatives that are still ongoing. Out of the first half of 2022 DPU of 1.46 cents, a cumulative distribution of 0.91 cents per unit for the period from 1st of January 2022 to 21st of April this year had already been paid on 23rd of June 2022. The record date for the remaining distribution of 55 cents is expected to be on 4th of August 2022, with the expected payment date on 27th of September this year. ELOG will be changing the frequency of its distribution to unit holders from quarterly basis to half-yearly basis with effect from the second half of 2022. Our portfolio recorded positive rental reversions of 14.3% for the second quarter of this year and 11.4% for the first half, led by the robust demand in new economy sectors of logistics and high-spec space. Portfolio occupancy increased to a healthy 94.1% in the second quarter, with the Singapore portfolio occupancy at 92.6%, consistently above the industry average of 89.8%. And the Australian portfolio occupancy at 99.4%, also consistently above the industry average of 99%. During the first half of this year, we secured a total of 196,000 square meters of renewals and new leases. New tenants secured include NTS Components Singapore Private Limited, while some existing tenants such as Aegis Nanotech and Renos Warehousing Solutions have renewed their leases. Leasing activities remain active with new demand from logistics, manufacturing, and electronics sectors. The weighted average lease expiry as at 30th of June of this year was at 3.0 years. Our top 10 tenants comprise 27.3% of the portfolio, with no single tenant contributing more than 4.7% of the portfolio, thereby reducing tenant concentration risk. As a result of the ongoing global supply chain disruptions and high energy prices arising from the Russian and Ukraine war, rising utility costs and inflationary pressures have been putting a dampener on the REIT's property expenses. However, we have proactively taken steps to mitigate these pressures. To manage rising utility costs, We have successfully converted a majority of our portfolio utility supply costs to SP tariff rates, while our tenants continue to pay us the same SP tariff rates. As such, with effect from 1st of July this year, more than 90% of the portfolio utility expenses are on a pass-through cost recovery basis. To mitigate inflationary pressures which affect repairs and maintenance costs within the portfolio, we will be progressively rolling out service charge increases at average 15% for selected assets across the portfolio. This is expected to mitigate any potential impact of inflation on repairs and maintenance costs. On the revaluation front, due to the continued strong demand for industrial properties resulting in a compression of cap rates in Australia, the valuation of our Australian directly owned portfolio saw a positive 9.8% increase, while the fund investments rose by a positive 6.8% during this period. This revaluation resulted in an increase in the REIT's NAV and is a testament to ELOG's strategy of acquiring freehold or longer land tenure assets to mitigate land lease decay and provide for NAV upside opportunities. We are embarking on a refreshed three-pronged active asset management strategy to unlock value for our portfolio through asset enhancement initiatives, divestment of non-core assets, and acquisitions, with the goal of recalibrating our portfolio towards modern, in-demand, quality, and scalable assets with freehold or longer land lease tenures. In April this year, we announced the redevelopment of a built-to-suit high-specs facility at 21B Senoko Loop for NTS Components Singapore to convert the asset from a general industrial building to a high-specs property, which is expected to achieve the Green Mark Gold certification upon completion. Other AEI projects in progress include 7002 Ang Mo Kio Avenue 5, which will create an additional 24,600 square meter of GFA, and 53 Peregrine Drive in Australia, which will conduct expansion works to create an additional 10,100 square meter of warehouse space. Both of these AEIs are expected to complete in 3Q 2023 and 4Q 2022 respectively. We have also announced the AEI of 16 Tai Seng Street, which will create an additional 2,793 square meter of space, bringing total GFA to 22,800 square meters. Extensive facade upgrading works are put in place to enhance tenant experience. The property will be fitted with electrical vehicle charging docks and is part of our pipeline of assets for our solar panel installation plan. On the divestments front, we divested 3 Sanitarium Drive, Berkeley Vale, for Australian $55 million at an 18.5% premium to fair value. On the 29th of July, we also announced the divestment of 49 Pandan Road for $43.5 million, which represents a 15.1% premium to valuation. As part of our recalibration strategy, we have also identified some non-core assets for divestment over the next 12 to 24 months to recalibrate the portfolio and unlock further value. Going forward, we intend to leverage upon ESR Group's portfolio pipeline of more than $59 billion new economy assets and $11 billion work-in-progress developments in an increasingly asset-scarce environment to focus on acquiring assets in the new economy sectors and overseas freehold assets or assets with longer land lease tenures for NAV growth potential. On the capital management front, our portfolio remains 100% unencumbered, with our gearing at a comfortable 40.6%. During the first half of 2022, we successfully refinanced all expiring debt due in this financial year 2022, a demonstration of ELOG's strengthening credit profile and strong banking support. Our all-in cost of debt has lowered to 2.97% as at 30th of June this year, with 66.2% of the REIT's borrowings on fixed interest rates. Our debt expiry profile remains well spread out, with weighted average debt expiry at 3.2 years. In June 2022, the REIT also successfully issued $150 million worth of NC5 perpetual securities at a 5.5% coupon. As at 30th of June, E-LOG has committed undrawn revolving credit facilities of $392.5 million. While continued rising inflation is expected to undermine business and consumer confidence, we remain optimistic on the Singapore industrial outlook, as the industrial leasing market is expected to continue seeing strong demand in 2022, supported by post-COVID demand recovery, structural growth drivers, supply-side friction, and e-commerce expansion. Prices and rental indices of all industrial space in Singapore rose due to broad recovery of the economy as prices and rentals continue to rebound. The taming of inflationary pressures will have an impact on growth, especially business sentiments and consumer confidence, and moderate the robust demand for space needs. Overall, we still expect an expansionary demand for the general industrial and logistics sectors to continue into the short to medium term. The Australian industrial sector is also well positioned to continue its momentum for another year of strong performance, with leasing demand of industrial and logistics space reaching an all-time high in the second quarter of this year, and national vacancy rates falling further to average 1.0%. This strong demand and tightened supply have resulted in national rents increasing to a record high of 5.6%. Our first half of 2022 performance reflects our enlarged, well-diversified and quality portfolio, which is well positioned to capture positive rental reversion upside, while mitigating rising utilities and inflationary pressures amidst a volatile interest rate environment with prudent risk management strategies. Our AEIs and redevelopments further position our portfolio to be future-ready as the circular trends and structural growth changes continue. Our portfolio recalibration continues as we pursue opportunities via AEIs, redevelopments, divestment of non-core assets and acquisitions through leveraging on our sponsor, ESR Group's robust high-quality pipeline of new economy assets in an increasingly asset-scarce environment. Going forward, we will focus on total returns upside by propelling E-LOG towards an enhanced growth trajectory by accelerating its exposure to in-demand new economy and longer lease tenure assets to provide rental and NAV upside to our unit holders. With that, thank you very much for watching. I hope you now get a good sense of the enlarged REITs matrix and our strategy to deliver sustainable returns to our unit holders. Don't forget to subscribe to our channel for our latest updates. See you next time.